Hey everyone, welcome to the Personal Finance Podcast. I'm Daniel.
And I am Anna.
And we love exploring things about personal finance as well as understanding how global news and trends impact our wallets.
Let us remind you that we are not financial advisors, but we dive into TED Talks, interviews with the best investors, books, news alerts, advisors analysis, and more.
You don't need to be a Wall Street expert to make smart decisions with your money. This episode is for you if you want to be able to think like a CEO of your own life.
Let's dive in.
Okay, picture the scene. It's in every single heist movie ever made.
Oh, I know where you're going with this.
The vault door swings open. Heavy gears, steam hissing, the whole production. And what's sitting there, it is never a stack of stock certificates.
No.
And it is definitely not a USB drive with a Bitcoin password on a Post-it note.
It is inevitably stacks of gold bars.
Exactly. Stacks of them, usually with that perfect cinematic glow.
Oh, yeah.
And it's just like visual shorthand for ultimate wealth. But I was watching one of these movies the other night, and I couldn't help but think, is this actually real? I mean, for us.
Regular people?
Yes, we're regular people.
Yeah.
We aren't planning a heist. At least I'm not. And we aren't, 17th century pirates. We're just modern people trying to figure out our 401ks.
Mm-hmm.
So the question is, does that shiny metal actually have a place in a regular person's portfolio? Or is it just like a pet rock for doomsday preppers?
It is a totally fair question. We often view gold as archaic or maybe just decorative.
Old-fashioned.
Exactly. But when you look at the research we're covering today, specifically this deep dive into the pros of gold explained, you start to realize that gold isn't just about jewelry or movie props.
Okay.
It functions as a very distinct, almost mechanical gear in the modern economic engine. It's not about nostalgia. It's about math.
Well, let's see if the math actually adds up. Because I'll be honest, I've always been a little skeptical. It feels like an asset that doesn't do anything.
It just sits there.
It just sits there. But this source material makes a pretty aggressive case that gold is a distinct asset class, that it belongs in a nest egg.
And notice the terminology there.
Asset class.
The source highlights that we aren't just talking about gold in isolation.
Right.
It's part of the precious metals group, which also includes silver, platinum, and palladium.
Which I found interesting. I usually just think of gold and maybe silver if I'm, buying cutlery. But the text treats them as a family.
Well, they are a family. They often move in sympathy with one another. But gold is the patriarch. It's the one with the deepest market and the most historical data.
Okay.
The core argument here isn't buy gold because it's pretty. The argument is framed entirely around three things: risk, balance, and behavior.
Let's start with that first one, risk. Or more specifically, that favorite buzzword of every financial advisor I've ever met, diversification.
Of course.
But I have to push back a bit here. Isn't diversification sometimes just a fancy way of saying accept lower returns? I mean, if I buy gold, I'm not buying that high-growth tech stock. Why does the source insist I need this metal in the mix?
That's the classic aggressive investor mindset, and that's fine, but here's the counter-argument from the text. Diversification isn't just about owning different things. It's about owning things that behave differently.
Okay.
If your entire nest egg is in stocks and the stock market takes a nosedive, your whole net worth moves in lockstep. You have no brakes.
So I'm all gas, no brakes.
Exactly. The source argues that precious metals act as a mechanical diversifier because of this inverse relationship.
Okay, this was the part where I started paying closer attention. The text claims gold moves inversely to stocks and bonds. But does it really? Is it a perfect mirror?
A perfect mirror? No.
So if the S&P 500 drops 10%, does gold magically go up 10%?
It's rarely a perfect one-to-one, and we should be careful not to promise that. But the correlation data mentioned in the source suggests a very strong tendency.
A tendency?
Yes. When traditional assets like stocks come under stress, say, during a recession or a market crash, gold prices often tick upward.
So when the stock market's having a terrible day, gold is usually having a pretty good day.
Generally, yeah. And it's important to understand why the source says this happens. It isn't magic, it's investor behavior. When big institutional money gets scared of the stock market, they don't just put cash under the mattress. They move capital into assets that are less affected by, say, corporate earnings or consumer spending.
They move it to gold.
They move it to gold.
So it's like a financial seesaw. When the heavy kid, the stock market, slams down into the dirt,
The gold side is forced up by all that fleeing capital. That is a solid analogy.
Okay.
And that movement helps offset your losses. The source phrasing is key here. It can offset losses either wholly or partially. It's a shock absorber.
A shock absorber.
It smooths out the ride so you don't panic sell your stocks at the absolute bottom.
Okay, so it's a volatility dampener. I can buy that argument.
Yeah.
But then we get to the second big pillar in the text, and this is the one everyone talks about at dinner parties. Inflation.
The silent killer of wealth.
Right, and we've all felt this recently. The dollar buys less milk, less gas, less house. The source brings up this relationship between gold and
Fiat currency.
fiat currency. To be clear, when they say that, they're talking about money that exists by government decree, like the US dollar, the euro.
The yen. It's not backed by anything physical. It's backed purely by faith in the government. And the source posits that gold is the anti-fiat.
Because you can't print gold.
Precisely. You can print trillions of dollars, diluting the value of every single dollar already out there. You cannot print an ounce of gold.
Right.
It has to be mined, refined, transported. That physical scarcity is why the text argues that when the dollar weakens, gold typically rises. It's preserving purchasing power.
But hold on, I have to play devil's advocate here, and actually the source does too. I've seen periods where inflation was high and gold, well, it didn't really do much.
It even went down.
Yeah. So if it's such a perfect hedge, why doesn't it work every single time the CPI print comes out hot?
I am so glad you caught that nuance because it is the most misunderstood part of gold investing. The text explicitly includes a caveat.
It does.
It says, gold doesn't always rise during periods of inflation.
Which feels like it undermines the whole sales pitch, doesn't it? It works, except for when it doesn't.
It feels that way if you're thinking short term. If you buy a gold bar on Tuesday because you think inflation numbers will be high on Wednesday, you're not investing. You're gambling. The source emphasizes that gold is a long-term investment. We're talking about trends over years or even decades.
So it's not a day trading tool.
Oh, absolutely not. It's a structural hedge. Over long periods, as the value of currency inevitably erodes, gold has historically maintained its purchasing power. It catches up.
But it might not catch up this month.
Or even this year, it requires a level of patience that, frankly, most modern investors just don't have.
Okay, so we have the volatility hedge, the seesaw, we have the inflation hedge, the long game against the printing press. But then the source pivots to something that sounds a bit more existential. It calls gold a safe haven.
And this is distinct from the inflation argument. Inflation is a math problem. Your money is losing value. The safe haven argument is about a crisis of confidence.
The text gets pretty grim here. It lists geopolitical instability, economic uncertainty, and global pandemics.
Right.
Basically, when the world feels like it's falling apart.
The crisis response. When political events make the future look murky, traditional investments like stocks and bonds feel fragile. They rely on a functioning economy, on supply chains, on stability.
And gold doesn't.
Gold is just an inert metal. It doesn't rely on a CEO making good decisions. It doesn't rely on a government paying its debts.
Okay.
The source describes it as a reliable store of value because it has no counterparty risk.
No counterparty risk. That's a real banker term.
It just means it isn't someone else's liability. If you own a bond, you're relying on someone to pay you back. If you own a stock, you rely on the company. If you own gold,
You just own the gold.
you just own the gold.
That's the bunker mentality.
Right.
When things get scary, people want an asset that just is.
Exactly. The source notes that during these times of high stress, investors flock to gold because they anticipate hard economic times that could devalue everything else. It's independent of the financial system's health.
But, and this is a massive but, that I want to spend some real time on, owning this safe haven isn't as simple as clicking a button.
Not at all.
Or at least it shouldn't be if you listen to the real purists. We need to talk about liquidity.
Yes. Liquidity, the ability to pivot.
And the source defines liquidity in a really interesting way. It's not just having cash. It's having access to value when you need to buy other better performing assets.
Right. Imagine the stock market crashes 40%. It's the sale of the century. Apple is cheap, Amazon is cheap, you want to buy, but all your wealth is tied up in assets you can't sell.
You have zero liquidity.
And you miss the opportunity.
So how does gold fit into this? Because I usually think of gold as being pretty liquid. I mean, if I have a gold coin, I can sell it, right?
In theory, yes. The source notes that gold generally adds liquidity because there is rarely a shortage of buyers. Someone, somewhere, always wants gold. However,
We run into the paper versus physical wall. The source breaks this down, and honestly, the logistics of the physical side sound like a nightmare.
It is a critical distinction. The source differentiates between gold-backed paper assets like ETFs or mining stocks and actual physical bullion.
So paper assets are easy. I can sell a gold ETF on my phone while I'm waiting for my coffee.
Instantly.
Boom, cash in my account.
Extremely liquid, instant execution. But physical gold, the source says this has more logistics to sell, and that is putting it mildly.
Let's walk through the logistics mentioned. Say I have that cinematic gold bar from the intro sitting in a safe in my basement. Market crashes, I want cash to buy stocks. What do I actually have to do?
Well, you can't just press a button. You have to physically take that bar out of the safe. You have to find a dealer, a reputable one, unless you want to get ripped off at a pawn shop.
Right.
You have to transport the metal to them.
And I'm guessing I can't just FedEx our gold bar easily.
Not without some very expensive insurance. And then the dealer has to verify it. They might need to assay it to prove it's real. All of this takes time.
The source compares it to real estate, which I thought was brilliant.
It's a perfect comparison. You can't sell a house in an afternoon to buy stocks. Physical gold is similar. It is slow money.
So by the time you get your cash...
the opportunity you wanted to buy might be gone.
So if I own physical gold, I'm safe, but I'm kind of stuck.
You're less agile. But, and this is a fascinating detail that most people miss, the source mentions a loophole. A way to unlock the liquidity of physical gold without actually selling it.
The borrowing strategy. I read this twice because it seemed counterintuitive. Why would I borrow money if I own gold? Why not just sell the gold?
This is a strategy often used by the wealthy, and the source highlights it as a key feature of top-tier gold investment companies. They allow you to use your bullion as collateral for a loan.
Okay, walk me through the mechanics here. I hand them my gold, they give me cash.
Essentially, you pledge the gold as security. Because gold is so stable and holds its value so well, lenders are willing to give you cash against it.
So I get the liquidity.
You get the liquidity you need to buy that cheap stock or a house, whatever, but you don't sell the gold.
So I still own the metal.
You retain ownership, which means if the price of gold goes up while you have the loan, you still get that gain. Plus, and this is key, since you didn't sell, you don't trigger a taxable event.
No capital gains tax.
None.
That is actually pretty slick. So you get the cash flow of a sale, but you keep the asset and avoid the tax man.
It's sophisticated, it bridges that gap, it turns a clunky, heavy physical rock into a flexible financial instrument.
But obviously you're paying interest on that loan.
Of course, the math has to make sense. It's not free money.
Right, but it does solve that slow money problem we talked about.
It does. It turns the store of value into a source of liquidity.
So let's try to land this plane. We've covered a lot of ground, from movie vaults to loan collateral. If we distill this source material down, what are the big three takeaways for you, for the listener?
Number one, diversification. Gold is the counterweight. It's the brakes in your portfolio car. When stocks crash, gold helps you stay on the road.
Number two, the inflation hedge. It protects your purchasing power when the dollar gets watered down. But, big asterisk, it's a long-term relationship, not a fling.
And number three, safety. It is the safe haven, independent of the financial system. But you have to understand the liquidity trade-offs. Paper is fast, physical is slow, unless you use that collateral strategy.
It's funny, the more we talk about it, the more I see the duality. It's this ancient, primitive thing, a lump of metal, but to use it effectively today, you have to treat it like a very modern financial tool.
That is the paradox of gold. It is the oldest money in the world, yet it still confuses modern investors.
Before we wrap up, I want to leave you, the listener, with a final thought to chew on. A bit of a provocation based on what we just learned about liquidity.
Let's hear it.
We talked about gold as the ultimate safe haven for the worst-case scenarios, total societal collapse, the zombie apocalypse, the end of the financial system. That's the pitch, right?
The ultimate insurance policy.
But think about the logistics we just discussed. Physical gold is heavy. It requires a buyer. It requires transport. If we are in a true end-of-days crisis, where roads are unsafe, or the internet is down, or society is fracturing, does owning a heavy bar of metal actually help you?
That is the uncomfortable question. Can you actually trade a Krugerrand for a loaf of bread?
Exactly. Or is the guy with the bread going to look at your shiny coin and say, I can't eat that? If the logistics of selling gold are hard now in a functioning economy, imagine how hard they would be in a real crisis.
Yeah.
It makes you wonder if the security of physical gold is more psychological than practical.
It is the difference between wealth and utility. A fascinating distinction.
Something to think about next time you see that shiny cinematic glow. That's it for this deep dive into the pros of gold. Thanks for listening.
Stay curious.